Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some earnings releases, and we're talking today about Guardian Holdings Ltd for their half-year period ended June 2021, as well as their parent company, NCB Financial Group, who would have reported for their 9 fiscal month period for their 2021 fiscal year. So let's take a look first at Guardian Holdings, who would have reported pretty decent results, and determine whether there will be continued good performance in the coming months ahead. So quickly, when we take a look at Guardian Holdings Ltd, again, for that 6-month period ended 2021, we see that the group would have generated an earnings per share figure of $1.10, which is a very impressive improvement of 55% from that 71 cents reported in the prior comparable period, that is the 6 months of 2020. Now, net income from insurance activities would have actually declined just around 24% from 551 odd million to 417 million, but that was offset by net income from investment activities, and overall net income from all activities would have increased 34% from 959 to just over $1.25 billion. Operating expenses also increased just around 24% from 618 to $770 million. And profit attributable to shareholders would have increased that very significant 55% from 164 to 256.1 million. When we take a look at net income by activity and its component, we can see that performance being reflected graphically, and we can see that there was that 143% increase in net income from investing activities in that fuchsia pink sort of color, from $317 million to just around $770 million. Offsetting that decline in net income from insurance activities, which fell, of course, as mentioned, from 551 to 417 million. One of the smaller segments, net income from brokerage activities, fairly constant, just a marginal 1% or decline from 73 to 72 million. So Guardian Holdings Ltd certainly faring well in the first 6 months of 2021 compared to 2020 on the back of a very robust financial market recovery and advances, in fact. Investment markets have been quite benign for the year thus far, and that has certainly helped Guardian Holdings Ltd and other similar companies cause in terms of their financial performance. However, the lingering and emerging threat of COVID-19 variants and their ripple impact or ripple effect on economic reopening uncertainty is going to leave us maintaining our neutral rating on Guardian Holdings for the time being, which is trading at a price of $33.25, helped by some of the excitement created based on its cross-listing in Jamaica earlier this year. The stock is currently trading at a price-to-earnings ratio of 8.9 times, below the sector average, that's the non-banking finance sector average of 11.8 times, and offers investors a dividend yield of 0.5%, which is below the sector average of 0.7%. But on a positive note, the group would have declared an interim dividend of 18 cents per share compared to no dividends in the prior comparable period. So again, we're going to maintain that neutral rating on Guardian Holdings Ltd for the time being. Turning very quickly to NCBFG, and the parent company of Guardian Holdings Ltd would have generated an earnings per share of just around 19 cents TT dollar equivalent, which is actually a 32 to 33% decline from the 28 cents recorded in the prior comparable period of fiscal 2020, and that was 28 cents TT dollar equivalent. On a positive side, net results from banking and investment activities would have increased by 26% from 2.6 to 3.38 billion TT dollar equivalent, no doubt helped by that very robust performance from an investment perspective of Guardian Holdings Ltd. Net operating income overall would have increased 12.5% from 3.7 to 4.2 billion TT dollar equivalent. Profit before taxes, however, would have declined just around 7.5% from 1.01 billion to 938 million, and profits attributable to shareholders declining from 678 to 454 million. Again, increases in operating expenses would have offset some of those revenue gains. When we take a look at net operating income by segment for NCBFG for this 9-month period, we can see that there were some notable changes. Net interest income was fairly constant over the comparable periods. There was that very robust resurgence in net income from investment activities and FX gains from 11 to 564 million TT equivalent. There was a 3% increase in net fee and commission income from 751 to 774 million. But there was a 22.5% decline in net results from insurance activities, again mirroring that performance of Guardian Holdings Ltd. falling from 1 billion odd to just around 830 million TT equivalent. So at a price of $8, NCBFG is trading at a price earnings ratio of 30.8 times, which is above the already inflated banking sector average on the Trinidad and Tobago Stock Exchange of 22.2 times, and offers investors a dividend yield of 0.3% below the banking sector average of 2.2%. NCBFG opted not to pay a dividend yet again to investors based on their results. Now, recovering financial markets should help. There is that economic uncertainty based on the developments of the new Delta variant and other variants of COVID-19, and those relatively high valuations of NCBFG at this particular point in time is going to lead us to maintain our neutral rating on the group at this point in time. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com. And of course, check out our website at bourseinvestment.com, where all of our research is free totally to the public. And of course, you can catch us in today's business section of the Bigger, Better Trinidad and Tobago Guardian newspaper. See you next week. Stay safe, get vaccinated. This has been the Bourse Report.